By now, you're probably getting the hang of how to handle foreign withholding taxes based on our past video on international equity ETFs, but complex lessons bear repeating. So this time, let's take what you've learned on foreign withholding taxes and apply it to emerging markets equity ETFs. Recall that the amount of withholding tax payable on foreign dividends depends on two important factors. The first is the structure of the ETF that holds the stocks. The second is the account type in which you're holding the ETF. By account type, we're talking about whether the ETF is in an RRSP, TFSA, non-registered accounts, and so on. Depending on these two factors, structure and account type, the foreign dividends on your emerging markets stock ETF could be subject to one or even two layers of withholding tax. Level 1 withholding taxes are those levied by the developing countries where the companies are domiciled, such as China, Brazil, and so on. Level 2 withholding taxes are incurred when the emerging market stocks are held indirectly via a US-listed ETF. In some account types, there's an additional 15% US withholding tax on foreign dividends before the US-listed ETF pays the net dividends to Canada. With this in mind, let's look at foreign withholding taxes for the emerging markets equity ETFs we introduced in our last video. The Vanguard FTSE Emerging Markets ETF, VWO, Vanguard FTSE Emerging Markets All Cap Index ETF, VEE, the iShares Core MSCI Emerging Markets ETF, IEMG, and the iShares Core MSCI Emerging Markets IMI Index ETF, XEC. In terms of fund structure, VWO and IEMG are considered US-listed ETFs that hold emerging market stocks. VEE and XEC are Canadian-listed ETFs that hold US-listed ETFs that hold emerging market stocks. When held in an RRSP or RRIF, funds such as XEC or VEE are subject to two layers of foreign withholding taxes. That's because they are Canadian-listed ETFs that gain their exposure to emerging market stocks by holding a US-listed ETF. The first layer of withholding tax occurs when the foreign companies pay dividends to the US. The second layer is levied when the foreign dividends are paid from the US to Canada. Since January 1st, 2014, the combined Level 1 and Level 2 foreign withholding tax drag has been substantial. In contrast, US-listed emerging markets equity ETFs, like IEMG or VWO, still incur the first level of withholding tax when the foreign companies pay dividends to the US. However, this structure is exempt from the second 15% layer of US withholding tax when held in an RRSP or RRIF. As we've mentioned in the past, that's due to a tax treaty between Canada and the US. And at least from the perspective of reducing foreign withholding taxes, this makes IEMG and VWO superior choices for your RRSP or RRIF. And what if you're holding emerging markets equity ETFs in TFSA, RESP, and RDSP accounts? No tax treaty exists between Canada and the US to exempt the 15% US withholding tax in these account types. So regardless of the structure, your investment will be subject to two similar layers of foreign withholding taxes. Again, strictly from a foreign withholding tax perspective, it doesn't matter which fund you choose. Last, let's look at holding emerging markets equity ETFs in your non-registered accounts. When you hold a Canadian-listed ETF like XEC or VEE, which holds a US-listed ETF that holds emerging market stocks, both layers of withholding taxes will apply, although the second layer of US withholding tax is generally recoverable each year when you file your tax return. For a US-listed ETF like IEMG or VWO, which directly holds the emerging market stocks, the foreign dividends are also subject to two layers of withholding taxes. And again, the second layer of US withholding tax is generally recoverable. So for foreign withholding taxes on non-registered accounts, neither fund structure has an advantage over the other. Once again, this foreign withholding tax material can be tricky, so feel free to review the content again if the concepts have got you stumped. In our next video, we'll review the impact of currency conversion fees when buying or selling US-listed emerging markets equity ETFs. See you then.